Hello, everybody, and thank you for joining us during Lytham Partners Fall 2023 Investor Conference. My name is Roger Weiss. I'm a Vice President here at Lytham. Today, we welcome two very experienced and thoughtful folks whose jobs are to sift through the economic and trading markets and make sense of the world's current investing environment. By way of introduction, we have Ryan Detrick, Chief Market Strategist, the Carson Group. Ryan is a recognized authority in the financial sector and is a chartered market technician known for his keen insights and ability to analyze market trends. As Carson's chief market strategist, he contributes a deep understanding of investment strategies and macroeconomic dynamics. Ryan regularly shares his insights on various national broadcast outlets such as Yahoo Finance, CNBC, Fox Business, and Bloomberg TV and radio. Also joining us is Art Hogan, Managing Director and Chief Market Strategist, B. Riley Wealth. Art is a highly regarded expert with a proven track record of providing astute market analysis and strategic guidance. He's a frequent guest in live interviews on CNBC, Fox Business, and Bloomberg, and his insightful commentary and straightforward manner have made him a respected and well-known figure in the financial media for years. When we last spoke to Ryan and Art, there was a laundry list of economic issues and headwinds facing us, including the Fed's rate hikes and inverted yield curve, bank failures, tightening lending standards, high office vacancies, war in the Ukraine, and a potential default of the U.S. government. Much to my chagrin, their combined responses were to politely yawn and to note that all the bad news had been factored in by the markets. In fact, they were both quite bullish. Gentlemen, last spring, you both agreed and did not see a recession looming in the second half of 2023. By the way, it was a lonely but very correct call. So how do you see things now? Art, do you want to start us off?
Sure, Roger. Thank you so much, and thanks for having us back. This is a lot of fun, and I can't believe it's been 6 months. But I would tell you this: I think that both Ryan and I were on a pretty lonely place last year, bucking this recession call that seemed to be the consensus. And the reason that we sort of fell into that was the economic data was not proving out any of those sort of long-held consensus estimates that, hey, leading economic indicators and things like the inverted yield curve always predict a recession. And I think what's different this time, and we talked about this a bit the last time we were together, is clearly that a lot of the economic data got skewed by what was going on in the pandemic. We very rarely have shut our economy down and then tried to reopen it and see what happens. And I think that using some of the old playbooks have really thrown some people off. And I think that not having a recession this year has become more of the consensus finally. And I think that's a real positive. But I certainly believe that when you look at an economy that's creating 266,000 jobs a month on a 3-month basis, which is what we have now, and clearly dependent on a consumer that is well employed, has high levels of savings, it's very hard to imagine going into recession with that kind of a backdrop. And that was the basis of my opinion at the beginning of the year, continues to be the basis of my opinion as we head into the back end of the year.
Great. Hey, Ryan, can you add something here?
Yeah, I probably can add one or two things, I think. 6 months, that was a long time ago. Also, I noticed you called us experienced. I think that means we've got a couple of gray hairs, maybe. We've seen one or two of these things. And a big fan of Art, and glad to be back again to do this. But, 6 months ago, what did we talk about? There are a lot of worries. You just listed a lot of worries. Those are real. We've got worries now, right? The worries haven't gone away. There's still worries. But I think at the end of the day, the consumer makes up about 2/3 of the economy. One of the big things that we came into this year, the Carson Investor Research, saying there won't be a recession this year. And we still don't think there's going to be one at least going out several quarters into next year because the consumer is so strong, right? We're making 200,000 to 300,000 jobs every single month. Wages are growing nicely. Inflation is coming back down. The Fed is likely done hiking. We're going to get in the weeds on a lot of this stuff. Just high level, though, you've got a strong consumer with jobs being created with strong wages. That's a good thing. Inflation is coming back down. That's a good thing. Then you look at manufacturing. A lot of manufacturing data PMIs, soft data surveys have been said, oh, recession, recession, recession. You look at the hard data, construction manufacturing is at an all-time high, right? Durable goods have been extremely strong. I can go on, but there's been a lot of positives. And I don't understand why so many people just gravitate, like Art said, like to the yield curve and leading indicators and some of the soft data. I get it. They've forecast recessions before, but you also have to look at the hard data. And the hard data to us is telling a wildly different story. And that, again, is an economy that is being led by a consumer with consumption at 8% annualized the last 3 months. That doesn't sound recessionary to me. There's a lot of positives out there, more so than the negatives. And if you don't have a recession like we didn't see this year and into next year, we think overall the equity markets are still going to do pretty darn well. You're going to have pullbacks, you're going to have scary headlines. We understand that, but a strong economy can make up for a lot of sins as it pertains to the stock market.
Very good. Well, Ryan, why don't we stay with you for a little bit here? And we are just coming out of a seasonally weak time of the year and are entering what generally is a more favorable time in the calendar. How do you see things playing out for the rest of this year? And what kind of tailwinds? Because, you've been talking about positive stuff here. So what do those positive tailwinds do for us?
Yeah, I mean, we're still bullish. We think we're going to have a pretty good chase in the fourth quarter, right? As we're in the fourth quarter now. Again, what's amazing to me is how well seasonality's played out. Like a year ago right now, we had that major bear market low, 25.5% last October. The average non-recessionary bear market's about 24%. 6 of the last 17 bear markets bottomed in October. Midterm years are like the worst out of the 4-year presidential cycle, normally bottom in the fourth quarter. You saw all these things. Oh, by the way, the first half of our pre-election year is when most of the gains happen in a normally bullish seasonal year. We know pre-election year is usually pretty strong. That's playing out again. And everybody under the sun said, oh, the first half's going to be bad. The second half's going to be better. We said, wouldn't it be something if it's the opposite? And it's kind of been the opposite. But you fast forward to where we are now, we've had, 8-9% pullback, depending on when you look intraday on the S&P 500 here on the third quarter. Not overly surprising. August, September historically are weak months. Here's the good news. The fourth quarter is up about 4.1% on average for the S&P, higher like 79, call it 80% of the time, close enough for government work. When you're down at least 1% in August and September, each of those months, so normally bearish time frame, it's only happened 13 times. All right, going back to World War II. The fourth quarter has been higher, 12 of them, up 7% on average. And what's going to get us here? What's going to happen? I think it's going to be earnings. I think it's earnings season. The realization that there is no recession coming. Corporate America is incredibly agile. It's able to create profits. I mean, again, there's certain sectors are going to be struggling, and we understand all that. But the consumer is still strong. A strong earnings report, along with the fact that inflation keeps coming back. Maybe we can talk about inflation a little bit. But inflation keeps coming back down. The Fed's done hiking. The Fed is done hiking with a strong consumer, with a strong economy, with better earnings. That's probably going to spark a chase into the end of the year. We expect potentially, the time we're doing this, S&P is a good deal, 8-9% away from all-time high. We wouldn't be shocked if we had all-time highs later this year or maybe early next year on the S&P 500.
We swing it to you, Art. Do you agree? And, kind of what are your thoughts for, especially third quarter earnings right now? And any observations and expectations?
Yeah, I think that's a great question, Roger. And I do agree with Ryan. And we agree a lot more than we disagree, almost constantly. And I would tell you, when we think about earnings, you have to think about the setup. We've had 3 quarters in a row where we've had either zero or negative earnings growth. So coming into the first quarter that we'll likely see positive earnings growth is a significant transition, which I think becomes a significant tailwind. Something very strange happened on the way to the third quarter earnings reporting season, and that's estimates went higher. Typically, estimates go lower during the quarter, and then by the time you wrap around and start earnings season, you've got a lower bar. It's gone up, and that doesn't happen that often. The same thing is true for the fourth quarter, and the same thing is starting to be true for people that are brave enough to put out numbers for 24. So all of that, wrap that up in a bow, and I would say that this earnings season likely delivers more good news than bad news, especially if we keep the estimates for the fourth quarter where they are. If guidance keeps us either unchanged or it nudges up a little bit, because the significant quarter this year where earnings really reset higher is the fourth quarter, and I think that's a real positive. I think what we're going to see, though, I think in the earnings reporting season is the worst performing sectors and market caps likely have priced in more bad news than they're going to deliver us, and they likely have the biggest upside surprise. So where would that fall? Clearly financials, who lead us off, right? are the worst performing sector in the S&P 500 for a lot of reasons, and Wells told things about net interest margins and the regional bank crisis we went through in March and all the other things we're concerned about, having to raise capital. But we're priced in so much bad news in the financials that even consensus reports, I think, is going to be a positive. The other thing that I think is probably trading at the lowest valuation that we've seen in years, they're small caps. So when we think about small caps, the Russell 2000, and Russell 2000 had a little bit of a spurt between Memorial Day and Labor Day, but it's really petered out and been hit a lot harder as the Treasury curve and the Treasury yields have backed up here. So I think a lot of the small caps are priced for some terrible news that they likely won't see come to fruition. So if you were to ask me, what do we think earnings does for the equity markets? I think it's going to be a real positive, but I think it's going to be more of a positive for those groups that are the most washed out.
So generally a pleasant surprise.
I think it's going to be a pleasant surprise, and I certainly think if we get the kind of guidance that we expect, if people don't start guiding lower, but start guiding towards what they're actually seeing in the real world, the hard data, as Ryan likes to refer to it, I think that's going to take our estimates up for the fourth quarter as well. And right now they're significantly higher on a quarter over quarter and year over year basis.
That's great. Well, let me change the subject a little bit. It was kind of a jarring beginning of the week in terms of what was news out of the Middle East. Ryan, with these new international tensions that came about, historically, can you put some of this into context for us? And in terms of, how wars and et cetera are digested by the market, and should we be worried about this? And, kind of historically, can you put it into context for us?
Absolutely. I mean, obviously, we all see the headlines. It's devastating what's happening in the Middle East, and our thoughts go out to everyone, and hopefully it ends very, very soon. But, the top question we've received, is, well, how in the world are stocks going up? Several days after all this started, stocks have rallied, right, at least initially. And the wondering is how that is. And the truth is, again, when you look and peel back the onion, we looked at about 30 different major geopolitical events going back to World War II. And yes, some of the returns after 9/11, you're talking World War II, some of the returns weren't that great. Now, those were also recessions, right? And you could argue 9/11 led to a recession, the financial crisis. Did Bear Stearns go under really cause stocks to crash? No, that was a symptom of a bigger issue. So what I'm getting at here, we've looked at other times. I mean, a year after 1990, when Iraq invaded Kuwait, stocks were up 10%. A year after JFK was tragically assassinated, stocks are up 23%. There are a lot of examples of some terrible times in history when stocks have done just fine. So we're not minimizing what's happening. You can have some near-term indigestion, near-term volatility. Absolutely. I mean, let's remember, just last year, right? Wasn't that last year? We had a lot of issues going on, and then the war in Ukraine, and that just pushed inflation higher. And obviously that didn't help, and it clearly hurt the overall bigger picture. But for right now, where we are, if things stay, relatively contained to that region and other parts of the world don't get involved, we're optimistic, as terrible as it is, that from an purely investments point of view, stocks probably can still have a fourth quarter rally. And one final comment, I love what Art talked about. I mean, Art talked about small caps and financials. We like cyclicals, right? That's kind of the cyclical world. We like cyclicals. We like small caps as well. We've seen yields peak. Now, who knows if they've peaked officially, but it's quite interesting that now that the tragedies happen in the Middle East, yields have started to peak. The U.S. dollar, which has been just a ripper for the last 11 weeks or so, that's starting to come down a little bit as well. So if yields in the dollar start to gently come lower, maybe it's because of what's going on in the Middle East, maybe not. Maybe that was the trigger, but it's happening. That potentially can be viewed positively from an investment's point of view.
Got it. Well, Art, let me kind of pull it back into your court for a second. Do you agree that we have seen the peak in yields? And, I think we heard out of the Fed something about higher longer. And, kind of how do you think about that in terms of the big picture? And, when you look at valuing things like the S&P 500, what kind of multiple, do you apply to that in terms of, looking out a bit and, with the interest rate environment we're in?
Yeah, great question, Roger. And to Ryan's point, when you talk about the seasonality, there's always a catalyst or reasons for seasonality, right? So we exited July with extremes. We had extremes in positioning, we had extremes in sentiment, and everything was overbought, right? So
Art, just real fast, remember some of those bears that were laughing at you and I? They turned bullish around that time frame. I was worried. I said, oh my God, now he's bullish? You knew we were due.
Yeah, sometimes you want to be lonely on that island of bullishness. Mm-hmm. So I would say that We actually spent the month of August and September working down a lot of that extreme, right? We went from overbought to oversold in a 40-day trading period, and it was amazingly quick. We pulled down multiples in the S&P 500 considerably, but underneath the hood, if you look at the multiple contraction we saw in the Russell 2000, the small caps, most of the not top 10 stocks in the S&P 500 had significant multiple contractions. So we worked off a lot of the excesses, and I think that was a real positive. The reasons were pretty clear, right? So seasonality is a big piece of it, but the catalysts were really, to Ryan's point, of extremely strong dollar, a parabolic move in treasuries, right, and treasury yields, and high energy prices, right? So flash forward to today, what do we have? All three of those catalysts have calmed down, and sometimes it's just spending a little time not going parabolic in any one of those catalysts that helps us. So the dollar seems to have reached a near-term peak, and that has settled down, even with some of the safe haven bid that it's gotten during this current geopolitical uncertainty in the Middle East. Oil has actually calmed down. So it's up a little bit this week, but it's down 8% last week, right? So we're up 5% this week. I think that parabolic move has quieted down, but most importantly, yields. And I think yields just did that 100 basis point move, yield on the 10-year in the month of September, of the last 2 weeks of August and the month of September. That's just not normal, right? We got that got very extended, whether you look at it on a RSI basis or you just look at it on a common sense basis. That has calmed down. So I certainly think as a driver heading into this quarter, all of these become positives. They go from being headwinds to tailwinds. I think that's what the fourth quarter run is going to be all about. And I would also offer up, when we think about the higher yield environment that we're in, and you're always going to get this question. It's like, okay, wait a minute. If the Treasury yield's at about 4.5 or 5% on the 10-year, what multiple do you put on the S&P 500? So going back to the days when I was learning my trade, we'd have a rule of 20. And the rule of 20 basically is 20 times is a fair multiple. You subtract out inflation. Now, if you live by the rule of 20 for the last 10 years, you would never be in the market. So that hasn't worked perfectly, but I would certainly say we're getting close to it. I think the best way to really contemplate this is to say, okay, well, we know the S&P 500 is trading at, like, call it an 18.5 forward, in round numbers. And if inflation is, closer to 4% than it is to 3%. So obviously the multiple is too high. I would offer up, let's take a look at the multiple on the equal weighted S&P 500. So back out the top 10 companies, and the average stock in the S&P 500 is literally trading at a 15.5 multiple. So I think that's relatively fairly valued. Take that a step further and look at the S&P 600, the small caps, or the Russell 2000 small caps, and the multiple is ridiculously low. So for me, I'm not so concerned about, hey, what kind of multiple do we put on this? I would rather rationalize it and say, what's the equal weight S&P 500, or what's the multiple of the average stock in the S&P 500? And I think that's what's going to drive. And to Ryan's point, when we talk about the chase, I really think the chase is going to manifest itself in the fourth quarter by those things that have underperformed. Ryan likes the cyclicals. I agree with him. I would throw in healthcare there as well, another sector that's underperformed. And I certainly think the financials have washed out here and likely do better. But I think when you think about multiples, you have to sort of think about that on almost a peg basis, right? So, when you look at the top 10 stocks, of course they have high multiples because they're growing very rapidly. Back them out and talk about the average stock in the S&P 500, and multiples look much more reasonable, and even more reasonable in the Russell too.
Got it. That's very helpful. There's an old saying about don't fight the Fed. How do we reconcile don't fighting the Fed with higher for longer? And does that mean we should be very excited now, since you guys think that the Fed has stopped raising rates? Or do we have to wait until we see the Fed actually going in reverse and lowering rates to be diving into the market?
Well, I'll take a stab at it, and I know Ryan's got similar thoughts. So my first stab will be this. I think you have to listen to what the Fed does, not to what the Fed says. They paused rates in the last two meetings, and they're likely going to pause again in November. That's not a big lift for me to say that. It's consensus. There's less than a 9% chance that they raise rates in November, and there's less than a 20% chance that they raise rates in December. Why is that? They are restrictive enough, and that is the tune that they're starting to sing. We're starting to hear almost every Fed speaker say, we've probably done enough. Yes, we're concerned about inflation, but we've probably done enough. So when the Fed becomes a real tailwind from a headwind is when they pause. Now, for a lot of reasons, when they start to cut is not the time to celebrate it, but when they pause is. So, and why is that? Then what happens is this amazing transformation where good news, economic data that's positive, becomes good news for the markets. when we're in the middle of a rate hike cycle, positive economic data turns into negative news for markets, and that transition is what we're starting to see. I would argue we started to see that already with the last jobs number we got. It was much better than anticipated. The market rallied. Why is that? I think with the market senses that the Fed is done raising rates and is starting to see that as a tailwind.
Got it. Ryan?
Yeah, love that conversation there, because since the jobs number, industrials have been one of the strongest groups, right? If that's what you want to see. You want to see a strong economy. You want to see industrials and things like that leading. We tried to talk about this 6 months ago, but we thought the Fed had a couple more hikes then, but it was probably going to be done. And now we think they're done. We think the Fed is done. We look at inflation. Shelter makes up 41% of core CPI. Shelter, rents, things like that are really drastically going to start coming down. The private data has been telling us this for several quarters now. We think that's one positive that's out there. And if inflation's coming back, the Fed doesn't really need to hike anymore. And Art is right. I mean, every time there's a Fed member, I don't even know half of them. They're on TV. I didn't know they're in the Fed, but they're saying the same thing. They're saying the tightening, the market's done its job. The tightening, all the higher yields on the long end of the curve have tightened things probably enough that the Fed can take their foot off the pedal. Timorous over at the Wall Street Journal, the Fed whisperer, he had an article just recently talking about something similar. So we're optimistic they can be done. I get so choked up talking about the Fed. Sorry. We're optimistic that the Fed is probably done, like I said. Now, here's one other thing about this, and I love what Art just pointed out. We think higher for longer makes a lot of sense, right? Every time we get the dot plots, they're probably going to take off a couple of the potential cuts that they saw, leave rates where they are for quite a while. We are a little out of consensus in what I'm about to say here, because what do investors remember? The last couple times the Fed cut, bad things happened. I'm talking, we're talking the financial crisis and we're talking COVID. But if you go back a little further in history, and I know this is going to sound crazy, we see some similarities with the mid-90s. And it's not exactly the same, I want to be clear. But in the mid-90s, the Fed hiked rates aggressively in 94. Then they took a pause in 95. Then they actually started to cut. And you know what happened? The economy grew. The economy did just fine. The 10-year yield the last 4 or 5 years of the 1990s averaged like 5.5%, give or take, right around there. So you can have a strong economy with the Fed that's cutting, with rates that actually yields that actually stay relatively high, 5.5%. And those are some of the big themes we're talking about in our shop right now. We really think, because inflation is going to keep coming back down, the Fed's probably going to start cutting in the second quarter next year, and we do not think that's going to be recessionary, even though the last couple of times they cut, it was. Yes, go back in your history books. History doesn't repeat itself. It often rhymes. Mark Twain told us. We think there's some similarities between now and 94, 95, which if you're an investor, that might not be the worst time to consider. Yes, bull market's got some legs. That's what we think.
Yeah, and Roger, I think Ryan points something out that's very important here. Unfortunately, our muscle memory is a short-term bias, right? So we remember when the Fed cuts, bad things are coming, right? So it's all about, are they cutting for the right reasons? And I think the right reasons are going to be, to Ryan's point, owner's equivalent rent, which is how the government measures shelter costs, basically, has a lag. And that lag starts to kick in the fourth quarter of this year. We're going to see that come down significantly. 25% of the CPI, 40% of the core CPI we actually could tell you that it's significantly lower. And we just won't see it until the government decides to take their survey again and show us what real live data has been showing us for a year.
It sounds great. I'm rooting for that. I have been taking notes here, and what I wrote down was financial stocks, small cap stocks, healthcare, cyclicals are all areas that we're pretty bullish on. Let's drill down a little bit, especially since our conference is about small cap names, and I know you guys have talked before. Let's talk specifically about the small caps, and how do you think about them right now? And what sectors within small caps should we be looking at specifically?
Well, I would tell you this from our vantage point. One of the benefits of small caps, which I think is a huge positive and not reflected in current valuations, is they're largely domestically focused and largely service focused, right? Both of those are real positives. Why is it positive to be domestically focused? We've got the strongest economy in the developed world right now. As Brian pointed out, estimates for the third quarter GDP sit somewhere between 2.5% and 5%, right? That's a positive. Fourth quarter looks like it's going to have an equally strong number. So small caps being domestically focused and focused on service more than they are focused on the production of goods sits in a place where they're actually in the core spot of what's going to be strong in the economy. So to me, when I think about small caps, I think it's going to be the ones that are the most washed out, domestically focused, and very much focused on services versus goods production. And that speaks to about 65% of the Russell 2000. I really think the valuation gap between large caps and small caps on a 50-year historic basis is likely as wide as it's been, going back to the 73 oil embargo and the 1999 and 2000 internet blow up. And that was the last time we've seen that gap that wide. I don't think we're sitting in either one of those places right now. And I think that's going to provide the significant tailwind into the fourth quarter and the beginning of next year for the small caps.
Mm-hmm. Yeah. Ryan?
Yeah, so it's a good thing you have me, I guess, and Art, because we do like small caps. Not a lot of people do. I'll be honest. Not a lot of people. We currently are overweight small caps and mid caps in the models that we run for our more than 350 Carson partners. And believe me, we've been that way for about a couple quarters. So it hasn't been comfortable, if most of us know about small caps, the way they've gone. But I'll tell you, there's still just so many reasons to think that wick just needs a spark, right? It needs something. And what Art and I have been talking about, I think, is the realization there's no recession coming. Now, at the end of the day, why are small caps struggling like they have lately? I think it is because yields are going higher. Because let's be honest, a lot of small caps don't make money. So when you look at these indices, it's harder to get financing. It costs more money to get financing. What does that mean? It eats into the bottom line. I mean, big companies like Microsoft and Google, all these guys, they locked in debt like at 2.5% a couple years ago. Now you can get 5.5% in a 6-year treasury. So they're printing money, okay? Small caps didn't have the luxury, at least most small caps in the luxury of doing that. That's the bad news. The good news going forward, though, like we kind of talked about, I think yields are pretty close to peaking here, right? The Fed is done. It doesn't mean that yields can't just, I don't think yields are going to roll over, but at least stop going up. I think small caps want to see that, and that could be that thing that really sparks it. Now, and I love what Art pointed out, because this is something we talk about too. Small cap, if you say, the market's kind of expensive, and it kind of is, pockets are, but if you take out technology, the S&P 500 forward P ratio is down to 16. Art talked about take out the top 5, take out tech, it's not that expensive. But if you look at tech, the Russell 600 relative to the S&P 500 on a relative basis on PE multiples, it's as cheap as they've been in like a lifetime, okay, going back a long time. So there are cheap parts of the market, and you don't want to buy something just because it's cheap. EM's been cheap for a decade, and it's underperformed the whole time. So we need other factors, but the factor yields are probably going to roll over the fact we have a domestic economy that's stronger than just about anywhere else in the world. I mean, just so the listeners know, the U.S. GDP this year has a chance, to quote Jim Carrey, right? Lloyd Christmas, you're telling me there's a chance. There's a chance U.S. GDP is stronger this year than China. Nobody would have thought that a year ago. That could be the case. Once that realization comes in, yields peak, we think there's some real positive on small caps. And we like small cap industrials, just to get a little more in the weeds. We think small cap industrials, kind of that services part that Art was talking about there, we think that's a really nice looking area for, again, not just rallying the fourth quarter, but honestly, probably a rally the next year. And one final comment. You talk about election years. Election years have a bad rap because 2008 and 2000, you had lame duck presidents and recessions. Just so everybody knows, you have a president who's his first term up for re-election, stocks usually do really, really well in an election year. So I'm not going red or blue. I'm just pointing out the facts here that if you hear, oh my goodness, it's an election year, it's going to be the end of the world like 2000, 2008. No, when you have a president up for re-election, stocks usually do pretty darn good. So does the economy. It's just some things to think about as we say why we like small caps.
Yeah, Roger, I'll add to that one more point. Ryan brings up some excellent points. But when we talk about the sort of fourth quarter chase, that typically manifests in a way where people look for what hasn't worked, right? And hey, let's go find what hasn't worked. We saw a bit of that in the Memorial Day to Labor Day run, and that was all about, hey, what hasn't worked here? So think about a world where the top 5 stocks in the S&P 500 in market cap would make up 3.3 Russell 2000s. That's how large the top 5 stocks are. It wouldn't take very much of saying, hey, this has worked. Maybe I use that as an ATM and start moving some of that money into small caps. It would take a very small part of saying, hey, the Magnificent Seven likely has had a run. Let's see what hasn't worked. Just think about the massive size and market cap, and just a little bit of that sort of focusing on some smaller caps and the Russell too would have a massive impact on valuations.
Got it. Great. I will take something you guys just talked about, a little bit of politics there. And Ryan, thank you. We've seen some interesting things going on in Congress of late. We may or may not have a new Speaker of the House. How do you think about the debt ceiling talks, which had been, the can was kicked down the road, but that road is coming up sooner than later? And any thoughts on how Congress may or may not function, in the coming year?
Yeah, I would jump in for my first thoughts on this and just tell you the reason we have a debt ceiling is we needed everybody in Congress to approve everything that we spent money on until we got into World War I, right? And then we said, oh, wait a minute, there's going to be a lot that the president will need to spend money on because we're entering World War I. That's how long we've had a debt ceiling. And oh, by the way, there's only one other developed nation that runs their finances this way. So this is a kind of a dance that we go through almost, every couple of years. We're going through it again. We never default on our debts, and we always raise that debt ceiling. But it's a time for the loudest parts of the extremes on the right and the left to make the most noise that they can while they have a microphone, and then things settle down and we come to an agreement. I think the same thing happens this year. I don't think it's going to mean we're going to have a lot more government spending. I think that the opposite of that is likely true. We're likely to be a lot more fiscally conservative as we sort of lay out our budget for this year, but it's going to get accomplished. And right now what you're hearing is the noise from the edges versus what the core of both America and Congress likely thinks. We're likely much more fiscally conservative, and I think that we'll likely get something passed. We've got till the end of November to get this passed. But again, this is a dance we shouldn't have to go through. There's a better way to run a railroad than the way we've been doing it since World War I. Doesn't make a great deal of sense, but I certainly think it's going to be something that we get accomplished. Agnostic of what Moody's and Fitch and the rest of the ratings agencies say, we always pay our bills, and we likely will again.
Great points there. I mean, everybody thought, really smart people thought we were going to go into government shutdown. And then all of a sudden it was averted, right? So, this stuff isn't for sure going to happen, but I'll just point this out. I think it's Denmark. Is it Denmark, Art?
Yeah,
the other country?
Right.
Yeah. Denmark's the only other country that does it the way we do it with debt ceilings anyway. So my friends in Denmark. But I believe since Eisenhower was the president, we've increased the debt ceiling like 72 or 73 times, something like that. We've done it a lot of times. We've kicked the can a long time. Here's what people need to know. I'm not crazy about a bunch of debt either. It is what it is, but it's how our country works. We still have the world's reserve currency. When the you-know-what hits the fan in March of 2020, okay, gold was killed, stocks were killed, bonds were killed. You know what went up? The U.S. dollar. During the recent stress we've had, the U.S. dollar has been stronger. Last year wasn't a great time for the economy, honestly, last year. U.S. dollar is really strong. When you have the world's reserve currency, I'm not saying it's right, not saying it's wrong. I'm just saying it's how it is. You may be complained by a potentially different set of rules. We do have a lot of debt. We do have higher interest rates. I'm not crazy about these things. But again, I think we've had this for a while. We've had a lot of debt for a long time. We're going to get through it. Washington's dysfunctional. We get it. You know who also gets it? The market. The market is smart. Anybody. Market doesn't care about a lot of this stuff. That's the honest truth. It cares about earnings. It cares about multiples, and it cares about what the Fed's doing. The dysfunction of Washington, I'm not crazy about it. Nobody is. But we might have near-term indigestion, yes, but major indigestion, we just don't think so. Final comment on this. In 2000, a lot of people didn't like President Obama. They missed out on some great gains. A lot of people didn't like President Trump. Missed out on some great gains. A lot of people haven't liked President Biden. Missed out on some pretty good gains as well. And there's still some time here. So let's just remember as we go into an election year, we all have our biases, yes, but separate your investment biases from your political biases, because I've seen so many people lose money or miss out on gains, is probably a better way to put it, because they don't like who's in the White House. It is what it is. Just focus on the economy when it comes to your investing.
Very good. Well, let me ask, Ryan, you just talked about the market. Let's bring it down a little bit. You both work for shops that have very, very strong and pretty large retail organizations. What kind of questions are you guys hearing from the financial consultants that you work with and your teammates? But they're the folks who are talking to retail investors on a day in and day out basis. What are their concerns and what's going on in the trenches?
Yeah, great question. I will tell you that there's similar calls. It's interesting. You kind of get similar calls, so it's easy to answer. So we have 800 financial advisors, and I speak to most of them on a regular basis. And the questions are always similar because they're coming from people that watch the news and are concerned about some things. So, flashback to when Fitch downgraded our debt. Well, what does that mean? And I had to put that in historic context and said, well, the last time our debt was downgraded, the market actually did better. I stole that data from Ryan because he posted it that morning, so it was very helpful. And I always tell him when I'm stealing his data, but it's the important thing is to put things in historic context. So the biggest question that was a surprise to me at this point in the cycle was just this week when he said, what do we do? I've got a large client who's concerned about stagflation. And I was like, oh, I thought we could put that one to bed. Let's just think about what you're saying here, right? So the stag part about that is a stagnant economy and high unemployment. And the inflation part is obviously inflation. So break those three pieces down and say, where do all three of these things stand? Inflation's heading lower, and clearly will continue to head lower. So we don't have that half of the stagflation. The other piece of the puzzle is we don't have a stagnant economy. As Ryan and I both pointed out, third quarter is likely going to be positive, somewhere between 3 and 4%, let's say. And the fourth quarter likely has a similar growth. So the other piece is the employment. We don't have high unemployment. We've actually have historically low employment. As Ryan continues to point out, we're creating between 250,000 or 300,000 jobs a month in an economy that's largely driven by the consumer. So to me, I think the biggest questions we get is kind of putting to bed some latent concerns about, hey, this is just like the 70s, we're going to have stagflation, or this is just like the 90s, or, kind of thinking back to what's the last time I was really concerned about the market. At the end of the day, I think that the most useful thing we can do is put historic context around things and make our financial advisors feel more comfortable about what's happening in the here and now.
Yeah, I'll chime in. Art, you mentioned you use some of my data. That's great. I like to put it like this. If you take it from one person, it's stealing. But if you take it from everyone, it's called research. That's kind of how I think we all work in this industry that way. I mean, we've talked about a lot of them, right? Inflation, the issues, the government shutdowns, and the war. I mean, we're not minimizing any of these things. They're all serious. Some other ones that we've heard lately, though, U.S.-China relations. U.S.-China relations are really poor. You hear about China and Russia and these other countries going after our currency. Well, listen, there's been currency wars for as long as there have been currencies. Maybe we didn't hear about it in the media, but that's nothing out of the ordinary. The other one that I hear a lot about, I don't have a real opinion on it, the digital dollar, right? Big Brother's going to make this digital dollar is going to track where all your money goes. Well, listen, everybody, I got news for you. They're already doing that. You've got credit cards. You've got things, your phone. Here's your phone, right? Your phone knows where you're going. I mean, if Big Brother wanted to track what you're spending, they already are. So I don't think we're going to have a digital currency. I want to be very clear on that, but I'm hearing more about that one. But at the end of the day, it's an honor to work with advisors and get to work with their clients. And like you said, the clients are hearing whatever the news, the word du jour is on TV. And the one final one, debt. I mean, $1 trillion of credit card debt, all-time high. That's not good. I mean, nobody wants to see that. But you know what? I call it denominator blindness. That's the numerator. Look at the denominator. Equity. Equity is up huge. We're at an all-time high in net wealth, right? Net wealth since 2000 is up 250%. Credit card debt's up 110%. I'm not saying $1 trillion of credit card debt's a good thing, but I am saying that's all the media talk about. There are a lot of other positives. That's what the stuff that Art and I get to do to kind of uncover what's really the story versus what you're hearing on the media. And believe me, there are concerns. One of my big last thing, a legit concern of ours is what if we have an energy spiral here with higher energy prices? What if we get more issues there? Directly inversely related with consumer confidence is energy prices. So crude oil goes to $150 a barrel, we might have a recession. I'm not minimizing that. We're overweight energy. I want to be clear, though, in the models that we run. But those are some of the things we're thinking about. We don't expect it, but that's a potential worry that could happen if energy prices continue to soar. I mean, natty gas is breaking out of a nice looking base going higher. So again, it's that time of year. It's colder. You got to pay more for natty gas. But still, those are some things we're looking at. But all in all, I think clients tend to worry about whatever they hear about on TV.
Yeah, you brought up a really excellent point, too. And I think that is that credit card debt. And Ryan was genius about the way he describes this to folks. It's like you got to remember the denominator, right? So you can't just say there's this much debt, credit card debt or personal debt, circular debt, and not talk about how many assets the people that have the debt have, right? That'd be like saying there's 330 million people in the country this year, and we have we have a record number of people. You're using math that doesn't make sense unless and until you contextualize that with what is on the other side of that. So the ability to pay that debt and how much excess assets that individuals have. And we just found out this, and Ryan's got a great slide on this, but we just found out that calculating how much of that the excess spending that consumers have was miscalculated. It's a lot higher than we think. So, there's a lot of easy things to throw out there to concern people, and if it bleeds, it leads. So I know how news works, but I think contextualizing that for the financial advisor and their clients is important to say, yes, that headline is factually correct, except for the fact you're not putting in the context that you need to understand what it likely means.
Got it. I think we're running out of time, so maybe one quick one, and we might have already touched on a little bit as we kind of look at the end of 2023. Early 24, kind of what is the greatest risk out there that you guys worry about in terms of just the economy and the market? Ryan, is it energy prices? Is it inflation? Is it, what keeps you awake at night?
Yeah, my son, we thought he broke his leg last night. Fortunately, he did not break his leg. We were in the hospital late. So that's what keeps me up, it feels like, most of the time. Playing football, go figure, 7th grade football. But anyway, back to the question here. For us, it's potentially higher energy prices, like massively higher energy prices, if the issues in the Middle East and some of those things were to spiral out of control. Not our base case, but I think it's that one. The other one, I like to spin it this way, and final comment and turn it to Art. What if people are just following the news and they're bearish all the time, right? That could be the biggest worry. People that are not using a financial advisor, not listening to the right people out there, following the same bear has been wrong forever, that aren't invested in the market, that don't understand that the way to create wealth is to invest in really solid companies. And oh, by the way, stock market's the only place things go on sale, but everybody runs out of their store screaming. When things are cheap, you might want to buy some. If shoes are cheaper, you're going to go buy them. Don't forget that. That's how it works with equities too. I mean, solid companies are usually going to go up. Earnings are going to go higher. So one of the biggest risks, I think, is people that follow all the bears on TV and forget the fact that stocks tend to go up, and that's how you create wealth over time.
Yeah, I agree with Ryan wholeheartedly in everything he said. And I think one of the things he was really pointing out here is that sort of, can you talk yourself into a recession? And certainly you can if confidence, consumer confidence, for somehow really gets hit. So think about it in round numbers. Consumers drive about 70% of our GDP. And if in fact we continue to sort of have this negative take from media or whatever it is that we're consuming to figure out how things are really going, versus how things are, how you feel. What's interesting to me about that is when we look at any of the soft data, the consumer sentiment data, and then compare that immediately afterwards to the hard data, which is retail sales, there's always a delta, right? There's always like, oh, consumers feel terrible. Well, retail sales were up 5%, right? So you're going to hear the exact same thing in the news. It's going to be a terrible holiday shopping season. It's not. It never is. Santa Claus always comes. We're always going to have solid consumer spending, agnostic to everything. And oh, by the way, why aren't we talking about the fact that the average price of gasoline has come down significantly over the course of a week? That's the one thing that we all identify with how we feel about the economy. Oh, gasoline's high. The economy must be terrible on it. They're probably not going to spend any money. Never really true, but certainly, as it's coming down, you certainly don't hear people saying, wow, gasoline's $2 in Texas and the average is $3.60 when it was $3.80 last week. So the national average of gasoline prices are coming down. A real positive for an economy that's driven by the consumer.
Very good. Well, I think on that note, we are out of time. So first of all, I want to thank you both very, very much for participating and providing your insight today. I've learned a lot. And I hope the folks who are watching this as part of Lytham's Fall 2023 conference and both enjoyed it and also participate in some of the other one-on-one and other panel discussions we're having. So again, everybody out there, thank you so much and enjoy the conference. Thank you again.
Thank you.
Thank you.